Well, good afternoon, everyone. Welcome to our Short Verticals webcast. I'm Connie Hill. I'm happy you have joined me here today. And this is what we're going to be doing every single week. Oh, Connie made a mistake. Let me fix it real quick. One moment. Welcome to our Short Verticals webcast. I'm Connie Hill. Trying to mute my little button here. It's not cooperating. There we go. All right. I finally got it working. But welcome to our webcast. This time is I think the same slot for our Short Verticals class. However, a new instructor, which is me. Today, we're going to talk about maybe some guidelines that a lot of people like to use when setting up short verticals. And I have a question for you. My question is, what is appealing to you about short verticals? I'll tell you what I find appealing because we're going to go in and talk about it. Now, I hope you're following me on X. I am at Connie Hill CS. Brent Moores, who I'm happy is in our chat to help us out. Brent is Brent Moores CS, and we'll post educational content, things we notice in the markets, things that we think you might be interested in. We are going to share those with you. So it's free to do, right? Just follow along and get in on those little tidbits that we send out during the week. Let's go through our disclosures, and then we will get on with our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today should be geared or viewed as informational and educational. Don't consider it a recommendation of any sort. We will be using the downloaded Paper Money platform of Thinkorswim. It's the most robust version. It's very helpful for option traders. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And an in-the-money option has a higher risk of being assigned early. That's especially important in our class here of short verticals. One thing that's different about Paper Money than a live account, Paper Money will not assign a short option to you early. Your real trading account absolutely can assign it to you early. Past performance of any security or strategy does not guarantee future results or success. I need to just adjust one little thing on my side, and we'll get moving on. As far as our agenda, I want to talk about verticals as though maybe we have some people in here that are newer to that strategy. What some of the things that we might consider when we're setting up. Like to show you a lot of examples. Typically, we'll have some examples to show you from previous weeks, but I reset the portfolio, so we are starting from scratch. We're going to be placing a lot of trades, and we're going to talk about what's ideal and maybe what's acceptable. Okay, now in wondering for you what you like about verticals that is appealing to you, let me just come over, take a quick look here. Looks like I've got something in the way here. I'm trying to get it out. There we go. Well, maybe, let's see. Probability of success, says Paul. That's one thing that you like about short verticals. Yeah, that is what some people will try to set up is a higher probability trade where you have limited risk. It's defined. We know exactly what that is from the beginning of the trade. And then some people like to set it up where they can have it be a high probability of success. Now, let's go over. We always want to be following the trend of what the markets are doing. All right. So far, we have not had that much of a Santa Claus rally, have we? Last few trading days of the year, last year before we hit the new year, they weren't all that bullish when we typically expect them to be. Today and tomorrow are the last 2 days of the Santa Claus rally. And as you probably know, market hasn't been all that bullish today. In fact, it's been a lot more the opposite. All right. So here's our SPX, and it looks like maybe we're bouncing up off the lows here a little bit. And it's interesting here because it kind of looks like, well, gee, is the SPX at support or is it breaking through resistance? It's kind of in one of those areas. Okay, but definitely we are seeing the weakness. We're seeing an equal bottom here, right as support. We'll see if the market bounces or not. Tomorrow may be the tell sign of that. Let's go to the NDX. And the NDX, some similar type of things where we're seeing a peak back here about 3 weeks ago. And, maybe there was a level of support in here, but it's just breaking through it today. We're having a lower low, right? If we compare that to the previous low, it's a little bit lower than what it has been. 2 moving averages I have on the screen, and we'll probably use these pretty frequently in this class. Red is a 30-day moving average. Blue is a 10-day exponential moving average. And with short verticals, many times we're looking at shorter time frames. And so the previous trend, we want it to be established, but if it hasn't been established the whole year or is in transition, we don't want to get too worried about it. Now, I'm going to pull up also for just a quick moment the Russell 2000. Probably the majority of what we look at in this class, since we're looking at liquidity, are going to be geared towards larger cap stocks. The Russell 2000 here is the 2000 of small cap stocks. Okay, so small cap stocks typically don't get the attention and the trading activity that some large cap stocks do. And so in this class, we're going to be paying a lot of attention more so to the SPX index and the NASDAQ, not so much on the Russell. Now, as we look at our first trade here, the first thing we're going to look at here is something that has been struggling a little bit. If the market is struggling a little bit, then we might look for stocks that are struggling a little bit. And I actually have some bullish and bearish examples here. Let's just start with this one on DHI, which is DR Horton, a home builder. What has been happening with the home builders? Well, we know they've been under some pressure because interest rates had kind of been creeping up for a bit. Now, we did get a small quarter point cut 2-3 weeks ago, whenever that was, but it doesn't look like many of the home builders have rallied off of that news. Okay, in fact, they're just continuing downward. If we look at what's going on here with the DHI, that 30-day has been downward trending for a long time. The 10-day exponential has been trending down almost the entire 3 months here. And what are we seeing going on with it right now? Technically, it looks like it tried to rally, didn't get much of a rally out, and looks like maybe today it's bouncing down off of that resistance. In a bearish scenario, in a short call vertical, many traders might look for either a bounce down off of a moving average or maybe off of a horizontal support level or even a diagonal level. They may even look at it at resistance. They might not even wait for it to bounce down. Now, your individual rules may vary how you like to look at things and how you like to time, but those are some things we'll be looking at here. So today, yeah, it looks like it is just bouncing off resistance here. So let's go ahead and construct a trade here. We're going to take a quick look at the trade, and then I want to come back to the chart and tell you why some people like to trade short verticals. Okay, let's set this up here to begin with. So we're going to go here to the trade tab. And as I do that, I have to get rid of my marker. There we go. Let's set out some guidelines for short verticals. You can see I just kind of typed it out here, the guidelines for short verticals. Number one, we're going to follow the trend of the stock, and probably that follows the sectors as well, and probably follows the indexes as well. Okay, so I'm just going to say follow the dominant trend. There may be times when we might see some mixed markets where we might have both bullish and bearish positions on. Right now, we're kind of seeing the weakness in the market, so we're going to try to take advantage of weakness, and DHI has been exhibiting it for a long time, not just for the last couple of weeks. Now, many traders like to sell in a range between, say, 20 to 40 days. Sometimes we don't get ideal. Sometimes we may end up selling 50 days out, like these options are here that are the monthlies for February. Sometimes they might be a little shorter than that. Maybe sometimes it ends up it's 19 days or 18 days, okay? But as long as everything else is in line and you like what you're seeing there, you might vary out of that 20 to 40 day window, okay? So I'm going to put sell 20 to 40 days worth of time. Not tokes, but time. There we go. Now, I'm going to assume this is an intermediate level class. I'm going to assume that most of you have a decent idea of what short verticals are, okay? But should you just be stumbling upon this and wanting to follow along, I want you to. Typically, what we're going to do is we're going to look to sell an option that's out of the money and create a credit, okay? So for this first one on DHI, we could take some time and pick through the weeklies to see what kind of activity there is, to see if we have what I'm going to put next, liquid options. Right? That means there's a lot out there, right? That means a lot of trading activity, narrow bid-ask spread. That's what we look for to say, okay, is this liquid? I'm not going to show you all of these, but say, for example, say that, I kind of like selling 30 days worth of time. That's kind of in the middle of, 20 to 40 days. Suppose you like that. You could come up here and open the window and just kind of see what the open interest is. Now, I have a special column set here that I like to use when we're looking at verticals. All right. So let me point that out to you. You might be interested in building your own custom set of columns here. Just kind of depends on what you like to do, right? But we have a delta column here. We're going to use that delta to help us decide which ones we might look at. Then I have open interest here. And you're going to learn, I'm a real stickler about open interest. I like you to be able to see lots of contracts trading. And if we're not seeing it in a weekly, don't fret about it. Just go out to the monthly. In fact, that's what we're going to do. I also have on here volume because sometimes it makes a big difference what is happening on a certain day with volume activity. Today's volume, not incredibly exciting, right? Just a few contracts going on there. But sometimes that volume that took place today and you add it to the open interest, then that might give you the feel that, okay, we've got a lot of liquidity here. Now, the last column, and we will pay attention to this, is the probability of this option expiring out of the money. Now, I think it was Paul that said, hey, one of the things I like about short verticals is probability trading and looking for a high probability trade. Well, what's considered high? All right. And if you have something that's 40%, not really that high of a probability of expiring out of the money, which is our goal with short verticals. But if you can start seeing high 50s something into the 60s and higher, then that is going to be considered higher probability. And so some people will use this column here to guide what kind of a strike price that they decide to work with. Okay, now seeing that we don't have a ton of open interest here, we're not going to worry about it. We're just going to collapse the January 31s. We'll look at the February's here. And as we look at February on the put side, we've got, in the hundreds here. Same thing here on the call side of things. Yeah, we're seeing some decent open interest. And when we see that, this bid-ask spread has a tendency to be fairly narrow, and we love to see that. Okay, now let's just put together a simple trade here. And let's see if the strikes I was considering using are still good here. Was considering selling the 145 and buying the 150, the strike price right below it. So as we look at this, we're looking at a 37, 38 delta, okay? Many traders like to sell 30-something deltas. Some traders don't mind selling high 20-something deltas. And so over here for our guidelines, I'm going to say delta. For many traders, your rules could be a little bit different. I'm going to say high 20s to 30s if you're looking for a lot of activity when you're looking for open interest, then you're going to try to put it in a range here. I'm just going to call this a 30-something, okay? All right, a 30-something delta. Some people might go out to a 40-something delta. Just because it's not exactly in the 30s or the high 20s doesn't mean you automatically reject it, but it might not be the first thing you'll look at or the first thing that you look for. So here we've got a 38 delta. Not enough contracts here. We're just going to be doing a couple contracts for our example trade. But this number right here, 67, is the probability of this option expiring out of the money. Now, is that considered high probability? Yeah, typically anything that's 60 or higher is considered high probability. Now, let's go take our strike price, 145, and let's go look at the chart. Because some people might base their trades only on probability, but I'm such a chart girl, I like to include the charts with it, okay? Because it would be nice to see if it's something you're selling maybe is above resistance, or it looks like, yeah, the stock could easily stay below there. So let me just check real quick. We're doing the 30, or that Delta 145 strike. So where is 145 here? I'm gonna make a line, which I like to do as well. Let's change our drawing tool here. It didn't do it the first time, so we're going to try this again at 145. Okay, so my mouse is pretty close to that area, 145 and some change. Does it look like that gives us some leeway? Well, it does. For the last, 7, 8, 9 days here, it's traded well below that and broke below it several days back here on the 18th of December. And so that gives us some leeway. Now, one thing that a lot of traders like about verticals is the idea that if the stock goes down, like we think that it will, that's one way to win, is when the stock goes down. What if it goes flat? What if it, let's go to where the current price is. If it just goes flat, could we still be a winner in that trade? Yeah, we could. What if it goes against us a little bit? Okay, what if it rises and maybe pokes above the strike price, but then comes back down? It could still work out in our favor. So we don't have to be exact. Stock doesn't have to do exactly what we'd like it to, right? We've got some scenarios where it might not drop on us, but we could still be a winner in the trade. It just might take us a little bit longer to realize that value in those profits. If the stock goes up, all right, and it's getting near options expiration, then you might be in some danger of not having that trade work out. So we very closely monitor about 4 to 10 days before the option expires. We're going to monitor it really closely, because if it's going against us at that point, we might want to get out. Now, if it's not going against us all that much, we might be a little bit more patient to let the stock continue to do what it's doing, whether that be sideways or whether it be dropping, or maybe it's around 145, but it's starting to show weakness. We might give it a little bit of time in, if we're beyond that window, certainly give it time. All right, so I'm going to put here, and as another guideline, we're going to look for exiting. And I'm going to put 4 to 10 days out before the expiration, right? Now, your rules may vary from what I put down here, but that's typically what we're going to be looking for. All right, let's go look at this one. We're going to go ahead. We're going to set it up. Let's do sell. Start with the leg you're going to sell in Thinkorswim, and you can just do right mouse click, sell vertical. And it'll go and grab the next strike price in sequence. Now, if that's the strike price you wanted, great. If it's not, that's okay too, okay? You can change it, right? If we were working with some weeklies and we had single dollar increments, yeah, we might change that and fine tune it a little bit. But 145, 150 is what this spread is going to be. Went the wrong way. Let's see, we want to sell it. Let me just change it here. I must have clicked on it wrong, right? Right mouse click, and then sell vertical. It must have slipped to the buy when I did that. So I just am changing it here. And it looks like the credit here is about $1.52. All right. So what is our risk reward, right? We want to know our numbers. We already know it has a 67% probability of expiring out of the money. And so that's higher probability. Let's do some numbers here. Let's grab our calculator. And I'm going to kind of lock this in. For ease of numbers, I'm just going to put it at 150. It's kind of flipping around here on us, but let's just go with 150. And so we would be having 150 per contract as our max theoretical gain. So our max theoretical loss is going to be the difference in the strike prices, which is $5, and subtract the whatever the credit is here. Okay, so we'd be saying, all right, we are looking to gain 150, so our max gain, and divide that by 350, which would be our max theoretical loss. Okay, let's see what the numbers work out to be in our calculator. So we'll go 1.5 divided by 3.5. Looks like a 42% return. Now, is that acceptable? Might certainly be acceptable to a lot of people. Let me put this in here, that it is 45%. Some people might say, gee, it's that high. Maybe I should sell further out of the money. Now you can. The next delta out would be here at 28. You can go ahead and run the numbers. When I ran them earlier, it looked like it would drop the return to about 29%, which some people find completely acceptable. For our purposes here today, we're just going to go with the 145, the 150. Now, how many contracts can we do? Well, we can risk in this class, what we're going to allow ourselves to risk per trade is $1,000. Now, your account might be different. If somebody has an account, and I just have this example on my scratch pad of, say, a $20,000 account, and they're willing to risk 0.5%, then maybe they would only risk $200. Okay, that would mean looking for lower price stocks, and it would include maybe trying to find some that are in dollar increments so that you can maybe fine tune what you're looking for. So you might not have as much flexibility here. Some people might have to risk more than 0.5% of their account in order to actually do some trading. So whatever the smallest number is without exceeding your tolerance is what you'd want to do. So if we're risking $350 per trade here, we allowed to risk 1,000. We're going to do 3 contracts here. Now I'm going to make this a first trigger sequential, and we're going to put in an order to exit the trade. Why are we going to do that? Because sometimes with short verticals, it might execute for you automatically. This is true with long verticals and any other type of trade that you put an exit in. You don't have to be there to try to catch it if you already have it established. So here, let's do an opposite order. And then let's decide when would we want to buy it back. Now, we aren't going to make more than 150. That's our max that we're going to get. But what if we could get a chunk of 150? What if we could get 120 or 130? Would we then be interested in going and just buying back whatever it's left and say, great, nice trade me, and move on? Yeah, some people might want to do that. So let's do this. If 150 is our max gain, let's suppose if we got 70% of that. If we got 70% of that, then only 30% would be less. So we're going to multiply our 150 by 0.3, and that says, okay, go buy it back at 45 cents. So we're just going to plug it in. All right, and that would mean we have a majority of that max gain. It might not end up being the full, what was it, 45%, right? We're willing to take a less than that in order to catch a majority of it and exit. So let's make this good till canceled. And this is a little bit longer in the time frame. Kind of goes out there to where some people are like, oh, I don't want to sell a lot more than 50 days. It's just kind of right at that threshold. But sometimes when the strike prices work out that way, that's just what you do, right? Let's go ahead. We are going to send this in. And after it fills tomorrow, I'm going to assume that it fills. I'll go ahead and I'll create a new group, and it'll be our short verticals group that we do in here. Now, if you have questions, go ahead and chat them in. Brent knows these strategies inside and out as well. And we're going to go at a little bit faster pace here. Let's see. Just checking to see if there's any questions I need to catch. And it looks like we are in good shape. All right. Let's move on to another one. Okay, when we're looking for things that are bearish, we want to pick on the loser, right? We want to pick on something that's already downward trending as opposed to something just having a little bit of weakness, right? That will increase our probability of success if we're sticking with the trend. Now, another one we're going to look at here is Microchip Technology, MCHP. Some of the technology stocks have been doing well, and some of them have just started to show quite a bit of weakness. Now, I'm only using a 3-month chart here. If it's downward trending on a 3-month chart, that's good enough for me. Okay, if you want it to be downtrending for longer, you can, but it might limit your opportunities if you're looking for, man, it's got to be downward trending a real long time. Okay, but because this has an established pattern of lower highs and lower lows, just keeps doing it. Again, what's it doing today? Looks like it's bouncing off that 10-period moving average again. And one thing you'll notice that when stocks are trending, I'm going to say consistently, many times they follow that 10-period moving average. When it's bullish, sometimes they're on top. If they're bearish, then sometimes it might use it as resistance, like it kind of has been doing here the last several days. Okay? So let's go take a look at what is available for Microchip here. Again, we're going to come back to the trade tab. It traded over 3.7 million today. We love to see volume like that because then that typically leads us to stocks that have higher trading activity. One criteria that you might use for verticals is you might say the stocks that you look at, you want them to average, I'm just going to say average volume of about 1 million. Some of you might change that. You might go 1.5 million or 2 million. Okay. Here we're going to say just a volume of 1 million on the stocks. And it doesn't guarantee we're going to find open interest, but it does enhance the possibility that that is going to be the case. Now, again, this one does have some weeklies, but they're just not that liquid. All right. If I flash open here January 31, when we're looking at our open interest column, we're like, oh, these are slim pickings. Don't worry about it. Just go out to the next monthly, which is what we're going to do. And we're going to follow the guidelines here. Let's see. I may have stuck that in a dumb spot. The stock's average volume, actually, do you know what? Let me adjust that and put it right here after our 4 to 10 days to exit. We'll put our volume there. All right. Again, we're going to look for a delta, many times in the 30s, sometimes in the 20s, once in a while maybe in the 40s. So we see what our possibilities are. We've got a 41, we have a 31. Plenty of open interest here for our 2 or 3 contracts that we might do. And let's go with this 62.50. Let's sell the 62.50 and buy the 65. As you look at this, 15 cents difference between the bid and the ask, 10 cents difference between the bid and the ask. Those are nice liquid options. We really want that to be as narrow as possible, and it looks like we have it with these. So as we sell this, make sure I stay in the right columns this time. There we go. We get our sell vertical. Let's see. And the next says, well, the options volume is in the 10s. Does that not play any role? Yeah, it absolutely does. Okay, so the open interest that we're keying off of here, we have 384 contracts of the ones we're going to sell, and then the one we're going to buy has over 1,900 contracts. Okay, so you're absolutely right. If we were looking in the weeklies and we were just seeing slim pickings, that's why I would come out here to the monthly options. Is there a minimum open interest that you would like to consider? Daniel asks. Many people don't want to be more than 2% of the open interest. Okay, so you think, okay, in round numbers, then if there's 100 contracts, you probably don't want to do more than 2 of those contracts. Okay, so that you're just staying a small minority in the pool of contracts. So great question. Appreciate you asking that. All right. Now this is a 60-cent credit on a $2.50 widespread. So let's run some numbers here for this one. Actually, I'll maybe move up here a little bit. We'll go to here. So this is going to be MCHP. The numbers up here were for the first trade that we did on DHI. And so here we're going to say, all right, looks like it's giving us a 60-cent credit. $2.50 widespread means our max loss could be what? Means it could be 190, right? Now, somebody's going to raise the question here or wonder, well, why would we risk more $1.90 to make 60? Why would we do that? And the reason traders might do that is because of the probabilities of the trade going your way. Look at this one right here that we're going to be selling, the 62.50. It's only a 31 delta, but what's its probability of expiring out of the money from the get-go? It's already at 74%. Okay, and so that's why people do it, is because they say, well, if there's a high probability that this trade is going to go my way, yeah, I will risk more than what I have to gain. You also have to be careful, though, because if you go through a series of trades and haven't risked that much, and then you take a bigger risk on something, and that's where you hit your max loss, it could potentially wipe out a lot of those gains that you had. And that's kind of the other side of the coin that you need to be aware of, is if it does go against you, all right, that you could lose more than what you actually had to gain. But the reason is this probabilities. And so that's why I say, if you want to set up a column structure like this that gives you the information you're looking for short options, just do it and have it there as a reference. I have mine called what the columns are because that helps me keep track of them. But you could label it if you wanted to. You could label it for verticals or whatever you wanted. All right. So as far as the probabilities go here, we'll clear that out. We've got 6.6 divided by what? 1.9. What kind of percent return is that going to give us? 31%. Now, is that acceptable to you? You'll probably start figuring out what is comfortable to you. Okay. 31% for our class is absolutely acceptable. So we're going to move ahead with the trade. And I do want to say the percent return, in this case, 31% based on the risk. If it was too low for you, you might look and see, well, should I do some different strike prices? You certainly could. All right. Could you slide it up here to the 60, sell the 60 instead of the 62.50? Yeah, you certainly could adjust things if you needed to. Okay. Again, we're going to do a certain number of contracts here, not wanting to risk more than $1,000 from up here. If we can lose $1.90, looks like we could do what? How many contracts? We could technically do 5 contracts here, couldn't we? Right? Because $1.90 times 5 contracts is going to give us a little bit less than $1,000. Well, we in the 900 somewhere, 950, 940, something like that. So we'll go with 5 contracts. Again, if this is not your threshold, that's okay. You don't need to do it. You can adjust your threshold. And especially if you're new, you just might want to sell 1 contract at a time. Do it in your paper money account. Get an idea how the trades flow here. Because I'm also going to tell you, these are trades of patience. These aren't trades that you're expecting things to happen in 2 days and out you go. Right? They're not really swing trades. They're probability trades where we have to exercise some patience. All right, so let's go and create an opposite order. And again, we might use, it started at 60 cents and based our numbers off of that. So I'm just going to put it back here at 60 cents. Okay, I'll make sure we get filled on it tomorrow. And then if we get a chunk of this again, what would we be happy with? You get to decide that number. If it's 80%, 70%, 60%, you know, you get to choose. Will you do 70% again? Okay, so we're going to go 0.3 times 0.6. It says, okay, go buy it back when it's 18 cents. Great. We'll put it in the system. We'll let it catch it. We can be out walking the dog, walking your cat. I don't know, cats don't like to do walks that well, but you could try it. And we're going to put in here 18 cents. Just let Thinkorswim capture it for you. Okay. And of course, we're very little of the open interest. So if we're doing 5 contracts, that's not too bad. That might be a little over that 2% that I mentioned to you, but not too bad. Okay. For class purposes, for our experimentation, we're going to go ahead with it. Good till canceled here. We're going to send it on its way. All right, there. Let's see. Kevin says, does anyone ever look for an expected value from game theory? In other words, EV 74% to 60%, 26%, $1.90. Okay, Kevin's just kind of asking some opinions there, so I will let you give your opinions if you want. You know, Paul is saying he would like to see, looks like 50 cents that you might like to see. All right, let's do one more example here. I had plenty to show you, but I want to go through the details, right? Explain what's going on. Next one up, we're going to pick on another stock that has started to show some recent weakness. AMD. All right, now it had been trading really nicely like NVIDIA and some of those stocks, but all of them are just starting to show some weakness. And again, what's it doing? It's following this 10-day exponential moving average, and it's just kind of sliding off of it. Okay, I would probably say this is close to being at resistance, maybe a little bit down from resistance. So we have a little bit of I was going to say movement in the stock that's indicating bearishness, right? And so we're going to say, all right, this is one that's kind of at resistance and bouncing off that 10. Now, we know this is widely traded. Okay, 24 million shares traded today. Well, that means maybe it's going to be a little bit more likely we could find something in the weeklies. On this one, let's just open up the January 31s and see. Oh, look at that. Lots of open interest here in that series. So what are our choices? We've got a 23 delta, a 32 delta, and a 43 delta. They're still in $5 increments. And so maybe the most likely that we'll go for, and you can see you could trade a lot of contracts here. If you were somebody that trades 10 or 20 contracts at a time, you're seeing the kind of open interest you'd want to see for that size of a trade. Okay, we're going to, again, sell the vertical. It grabs the next contract in line. So 130, 135 is what we're going to work with here. And I'm going to just lock that in, okay, at $1.12, $1.12 credit. All right, what would be our max risk? Well, on this one, because it's back to a $5 wide spread, right, would take $5 minus 1.12. That's going to be close to our first trade there, which is 388. Okay, so max gain is $1.12 and max loss is going to be 3.88. All right, should we see what kind of a reward we might be in store for? Again, if we look at the probability of expiring out of the option or out of the money, 72%. We love seeing that above 60. You know, and here this particular one's in the 70s. That makes us happy, especially if we find the return that it's going to give us acceptable. So let's go $1.12 divided by 3.88. That says it's a 28%, a high 28%. Now, some of you might go, oh, nothing below 30, never ever, nothing below 30. And there might be somebody that go, I like that, right? I like that it's got a higher probability. I'm okay with a smaller return. And I'll also mention there's a smaller period of time. Some people might even be tempted to go, well, what's in the 22 days to options expiration? We actually have same strike prices, but you can still see out here lots of liquidity, but it's going to end up being very similar to what we're doing on the next week out. All right, so there's our $1.12. We could lose 388. That would be our max theoretical loss. So we are going to do how many contracts? We're going to do 2. 3 is just a little bit too much. Okay, so we're not going to exceed. We'll do 2, and actually I put that in again. I must have a little weakness in my mouse control. Okay, the price hasn't changed that much. Okay, it's saying $1.14 here. That's fine. We calculated at $1.12. First trigger sequential and create an opposite order here. And on this one, would it change? Would our approach change? Probably not. We'd still probably say if we get a majority of this, then we want to get out of the trade and be on to our next trade, right? Because at that point, and we'll get into this more as we start kind of managing these trades, what you're going to find is that when you've got a big chunk of the gain, you're risking a whole lot more for just a little bit tiny return. And so you think, maybe it's not worth that additional risk to to try to get the last nickel out of it, the last dime out of it, if I've already got a big chunk sitting here. All right, so let's go here. Yeah, let's change it around. Let's go 114 here, okay? And if we can get, in this case, let's do 75%. If we can get 75% of the spread, only 25% is left. So we'll take 114, multiply that by 0.25. That says, okay, go buy it back at 28 cents. It goes, buys it back at 28 cents. Great, we're happy. We're out of the trade, we move on to a new trade. And what we're trying to do is, with this strategy, some people try to develop some cash flow, right? They'll also be watching it closely as it gets to options expiration. In our case, we have quite a bit of time until options expiration. If it goes and it hits these percentages early, well, that just means happy are we, right? If it gets you out of the trade in 5 days and you're thinking it was going to be like 20 days, you're like, okay, then I'm happy with that. All right. Now, Jerry has a question. How do you manage the trade if the trade is going against you? Yeah. One, people will look and see where is that short strike price. When I'm finished here, I'm going to document our charts. I'm going to come through and I'm going to put in the short strike price. I believe on this one it's 135. If I can get my mouse to 135, about here. If the strike goes beyond 135, and it looks like maybe it's breaking through some resistance that you really thought it would stay below, that could be a reason to exit early, okay? Some people, if they have a lot of time left, say that happens, say it closes above your short strike, but you still have 30 days, 40 days. Then people might say, well, let's just see if it comes back down. Maybe it's just a one-day wonder, okay? So breaks of resistance, changes of trend are going to be the big things we're going to watch for here, okay? But we already know probabilities, we're going for the higher probability trades. Could it happen to us? Absolutely, right? Trends change. So it's not one of the trades you walk away from, but you do have to be a little bit more patient as time decay erodes and that theta value starts to kick in a little bit higher and a little bit higher the closer we get to options expiration. Lee, okay, thank you. Appreciate Lee was trying to save me from sending, and so was Debbie, when it was switched around looking like a buy vertical instead of a sell vertical. Appreciate your catching those things for me, letting me know. All right. So we talked a little bit about short verticals, the idea, trying to create a higher probability trade, looking to follow the trend, looking to sell, in the case we did 3 bearish trades below resistance, and having some leeway so that, if the stock goes 3 out of the 4 ways down, even, slightly up, not beyond your strike price, 3 out of the 4 ways, you could still possibly be a winner in this trade. Now, if you haven't practiced this, practice in your paper money account, okay? And just get a feel for it. Just do like a single contract and get a feel for how the trades develop. Okay, that'll help you decide what your kind of rules where you want to be as far as your percent return, how much you want to risk on the trade, those types of things. Okay, so I would say if you haven't traded any of them before, trade at least 10, right? To get the feel of it, what's going on, kind of get some bearings about you. And some people will trade a lot more than that. But that's why I'm saying do at least 10 in your paper money account. It doesn't mean you're going to be ready, but that's a good effort to getting you that way. Now, we're going to have a short break here in our programming. I appreciate you all being here today. Brent, appreciate you being in the chat, answering questions. I hope you're a subscriber already. If you're not, go down and click on the YouTube logo that says subscribe. Makes it a lot easier to find our content when you do that. So become a subscriber, follow Brent and I. It's free to do, free for you to join Twitter and follow us along, get those little tidbits during the day. Now, coming up is going to be getting started with stock investing. That time has changed. It was Friday afternoons. Now it's going to be Thursday afternoon, right at the top of the hour, which is going to be about 3 o'clock Eastern for most people. Well, I should say 3 o'clock Eastern. Adjust it to your time frame. All right, you guys have a good day, and we'll follow up on all these trades next week. We'll see you then.